This week, the big story in property is confidence, with both property buyers and sellers' confidence having jumped sharply since the latest interest rate cut. Look, it's palpable on the grounds. Our buyers agent of Metropole are seeing it, but it was also evidenced in the auction clearance results over the weekend. Last week, Westpac-Melbourne Institute Consumer Sentiment Index was reported that it's now sitting at the highest level since March 2022. And when it comes to property, the improvement in property sentiment is clear. The sentiment time to buy dwelling index rose to a 4-year high. That means that buyers are clearly seeing an opportunity at the moment. Confidence is also being boosted by falling mortgage rates in the media. At the same time, house price expectation index was running hot. It's the second highest level since 2013. So this renewed optimism is already showing on the ground with stronger buyer demand, higher loan approvals, more robust auction clearance rates. So to discuss how all this is playing out in our housing markets, as always, I'm joined by Australia's leading housing economist, Dr. Andrew Wilson, chief economist of My Housing Market. And Andrew, I'd like to take a closer look at how all this is playing out in our housing markets.
Yes, a little bit amusing, Michael, that finally the surveys are catching up with the reality of what we've been discussing for months now, and of course, people do start to say or report in the surveys what they've been hearing in terms of results. But finally, the confidence surveys are catching up with the reality of what we've seen for quite some time, really, when we look at not just housing market activity, but also the on-the-ground economic activity, which has been unequivocally positive for some time now. But as we always discuss here, those soft methodologies, those soft insights, surveys have to be taken with a grain of salt because they do typically lag what the real data tells us going forward. And the real data has just revealed another very strong winter, the strongest perhaps in some time, but we've got a few days to go in winter, so we'll wait and see what that tells us. But certainly this is a heady housing market, Michael. We shouldn't be surprised. Lower interest rates, of course, will always generate higher house prices, even in the worst of times. And as we found out in the early 90s recession, where prices continued to rise, even though we had very high unemployment once interest rates were cut. And of course, we have a very strong economy at the moment with still low unemployment rates and high participation rates. So onwards and upwards. And of course, I guess sellers would be salivating at the prospect of the spring selling season, which is now very much upon us.
Well, one of the indicators that we look at is housing loan approvals, because that's a leading indicator. Most people go and get their loan approvals before they go out into the market. And that's been very positive as well, hasn't it?
Yes, Michael, look, it's a little disappointing in terms of the ABS series. We used to report this on a monthly basis because the ABS were releasing the home loan data, the lending data on a monthly basis. However, over the past year, 9 months, they've reduced that to a quarterly basis. So it's a little bit backward looking. However, look, we've been reporting it, so we will continue to report it. It's reasonably helpful because it gives us a breakdown in terms of buyer types. Again, it's the June quarter data. We're nearly into September, and we're talking about data that, goes back to April. But as I said, it gives us a sense, albeit a backward-looking sense, of how the markets are performing. It's just a shame that, and this is something that's been happening not just for this particular data set from the ABS, but other data sets as well, that they've, whether it's, budgetary constraints, whatever, they are reducing their output, which, for those that are looking to make informed decisions, particularly about the property market, it's a bit of a negative, because we don't have as much evidence going forward to support, other models of what's happening in the housing market. When we look at the latest June data, home loans were higher over the June quarter, up by 1.9% compared to the previous March quarter. Investors were the big movers. They are up by 3.5% over the quarter. Total home loans inched higher by around about 0.2% over the year. As I said, investors were the top performers, up 3.5%. First home buyers were up 1.7%, owner occupiers up by 0.9%. When we look at the breakdown in terms of estate by state performers. Victoria was the best performer overall for home loans, just a little higher than New South Wales over the June quarter, ahead of Queensland. Victoria was also the top performer for annual home loans. This is total home loans for dwellings, up by 21.4%, which, correlates with other data that we've had in terms of rising auction market activity in Melbourne and rising prices also in Melbourne. So look, some interesting insights there, Michael. But again, it's quarterly data. We're used to the monthly data, and it's just a little disappointing we don't have that to relate to. But nonetheless, it does show us certainly that investors are still very much active in our housing markets. And no surprise, because rising prices will always incentivize more investors into the market wanting to take advantage of capital gains going forward. But we're still tracking below the revival levels of the post-COVID period in terms of home lending. Positive results and certainly supporting what we're seeing in prices and auction results, but we are looking a little bit backwards, Michael.
Well, another result that came out in the news recently, the Australian Bureau of Statistics showed how our wages are growing. Most people would be complaining, Andrew, that their wages aren't keeping up with inflation.
Yes, Michael, this is an interesting data set. This is the wage index, which is also quarterly from the ABS, and it always has been quarterly. It's a bit more of a problematic data set to gather because it's based on a disparate series or a disparate number of inputs. But the wage index was up by 0.8% over the June quarter, which is a little lower than the 0.9% reported over the March quarter. Wages growth up by 3.4%, which is, that's steady in terms of what we recorded over the March quarter. It means that we're almost tracking at a neutral position in terms of where inflation is running and where wages growth is running. Of course, we had real wages, which is the difference between the inflation rate and wages, falling during that high inflation period. But now we've got inflation now in the midpoint of the target range, 2 to 3%. We actually have wages rising a little bit more than that. So real wages growth is increasing, but it doesn't probably feel that way, Michael, because it's a little bit of a mixed bag in terms of what has reduced the inflation rate. But I think it's interesting because we have a very strong labour market, Michael. Lowest unemployment rates, or as low as they were during the boom period of the mid-noughties, the great mining boom period, then similar unemployment rates, a much higher participation rate. You would expect strong competition amongst workers, which there is, because there's plenty of jobs out there. I think, on the unemployment rate, employers are still struggling to match their labour needs. You would have thought that would put upward pressure on wages, which we did see a year or more ago, Michael, when we had wages growth at around about 4% plus, which is what we would expect with low unemployment rates and high participation rates. Now, that hasn't changed much over the past year. We have the same unemployment rate we had a year ago, and we actually have a higher participation rate. And yet we've got a significantly lower growth in wages, 3.4%. This really does, and we had a big fall at the end of last year in wages, in the wages index from that 4.1% of a year ago. And I'm just questioning the methodology here, Michael, because it doesn't stack up with the historical nature of the series and also the other clear drivers of wages, which is the labour market. So, 3.4%, I'd suggest would be a little bit disappointing to those out there, particularly given how strong wages growth was a year ago. And now we've come down significantly. And I think that when we did see that big fall in the growth of wages a year ago, the ABS were saying that it was about the national wage case that had come in considerably lower than expected. And perhaps that national wage case is just interfering with the wage index series to the point where, it clearly has question marks about it. But nonetheless, we are now seeing wages increasing at more than the inflation rate. So that means notionally real wages are growing, so we can have some satisfaction in that, whereas we had a higher wages growth a year ago, we actually had real wages falling because we had a higher inflation rate, if you get my drift.
There's been a lot of public sector jobs created over the last little while too, and those latest statistics from the ABS showed that private sector wages growth grew at 3.4% over the previous 12 months, lower than the 4.1% that you mentioned a year beforehand. But public sector wages growth grew a little bit higher, 3.7% in the quarter compared to 3.9 the year a while ago. So I guess the public sector are pushing up wages just a little bit.
Well, perhaps they've got more leverage, but there's some similarities there. But I think we should question this to some degree because there's been a significant change in the series and it's holding. And we need to perhaps ask or question the methodology, particularly given that we haven't seen any real changes in the labour market, but we've seen a lot of changes in wages. And the other point is, Michael, we're not seeing the same migration as well. So we're not. We're seeing fewer migrants come in. So you would expect, well, there's fewer people looking for work, and yet we're not seeing any uptick in wages growth. So a little bit questionable.
I just wanted to remind you that this is not specific investment advice because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of the opportunities the current property markets are offering. So why not have an obligation-free chat with one of the wealth strategists at Metropole to discuss your goals, your options, and what you could do. We're much more than just another buyer's agent. We help you safely create intergenerational wealth through strategic property and wealth advice. Remember, property investment's a process, not an event, so you can't just go out and buy any property and hope to be successful. In fact, now more than ever, getting the right advice is critical. So if you're looking to invest in property or buy a home, go to metropole.com.au and organise a time for an obligation-free chat. You're going to find that at Metropole we're big enough to tip the scales in your favour, but still small enough to care. And since we don't have any properties to sell, our advice is independent and unbiased.
Well, also, as you said at the beginning, this is backward looking. It's for the June quarter, April, May, June. And since then, there have been a couple of changes. So, and some wages have gone up. So even the ABS in its report, when they put out these figures, suggested that the real wages growth could be a little bit higher since that happened. A shame we've got to look backwards. On the other hand, we can actually see what's happening in real time when we take a look at what happens to the auction markets. And it's been a very strong winter auction market. I guess officially there'll be one more winter auction Saturday weekend coming up. How did things go last weekend, Andrew?
Well, just adding to that, strength in the auction market, and also, wages growth probably hasn't taken into effect the interest rate cuts that we've had in May and again, of course, in August. And as you said, it's backward looking. The interest rate cuts have certainly added to auction market activity and confidence, and perhaps they'll work their way because with more money in their pockets, businesses will be looking to expand on higher demand, and that will mean employing more workers potentially. But the auction markets, no surprise, we should say that, but maybe it is a surprise that Sydney and Melbourne continue to lead the late winter auction results. It's been a very strong winter market, one of the strongest we've had for some time. It's a very positive leading to the spring selling season. Seasonal effects were still apparent in some of the markets, particularly in regard to prices, and particularly the Melbourne market, where the prestige market still hasn't given the same energy or signs of increased energy that the mid-price markets are there. I think you'll find during spring that those higher price sections of the Melbourne market will back into the revival that the other sections of the market have been experiencing. But Sydney and Melbourne, again, led the results in terms of comparisons with capital cities. And as I mentioned, as the spring selling season approaches, we'll see reiteration of what we've seen over previous weeks, and that is an increase in listing numbers. But even with that increase in listing numbers, those auction clearance rates still clearly favour sellers. In Sydney, we had a big rise in auctions, 914 auctions, up from 837 the week before. Clearance rate, again, we can say, yep, okay, that's just about a boom time result, 79.5%. Very similar to the week before, which was 80.1%, and again, significantly higher than a year ago. Melbourne was higher, its clearance rate 76.5%, which was up on the 74.8% the week before. Auction numbers in Melbourne also were significantly higher, 943 versus 873 the week before. We're almost 15% higher now, the Melbourne clearance rate, compared to the same period last year. So very strong results for Melbourne and Sydney. Brisbane continues to float between 40 and 50%, but it did have a big rise in listings, 175 auctions last week in Brisbane compared to 124 the week before. As we always say, that Brisbane market has a different culture in terms of auction activity, so we need to take it, differentiate it in terms of the results from the other capital cities. Adelaide down a little bit last week, 63.7% after a good run of 70 plus results, so down to 63.7%. Again, higher auction numbers in Adelaide. And Canberra, a little bit more of a rational result. Can we say that for Canberra, who's been trundling along in the 50s and low 60s for some time? Gave us an 86% clearance rate the week before, which was quite remarkable, but still a very good result, and at 72.9% for Canberra, Michael, and certainly amongst the best results that we've seen for quite some time. So, a sense of revival in that Canberra market, and of course, when we look at the trends for auction activity, it's almost the same for every capital city, where we see a big rise this year following those reduction in the monthly clearance rates, following the interest rate reductions. And, as I said, this is a very strong precursor to the spring selling season, which commences next week officially. And gee whiz, if you're looking to be in the market, particularly as a seller, and most buyers are sellers and sellers are buyers, I guess it gets back to our original discussion on confidence. You'd be feeling pretty confident of a reasonable result going forward. And you never know, we might get another interest rate cut as well to drive that market even higher. Lower interest rates, higher auction clearance rates across the board, and higher prices. And as I said, it's been not a very chilly winter in terms of the housing market. And if you're looking for the latest auction results, you can get the snapshot results at my LinkedIn channel, Doc Andrew Wilson at LinkedIn, every Saturday night at 6 o'clock for the snapshot. And Michael publishes the full national report through his channels on Sundays, and that includes the regional breakdowns for Melbourne and Sydney and the top 10 auction sales for each of the capital cities over the past week. So next week I'll be saying happy spring to you, Michael.
Yes, you will, but we will speak before that, because we're going to catch up, and I know my housing market brings its end of month reports just a day or two before everyone brings theirs out. So I look forward to catching up with you, and we'll report those over the weekend. I think we wouldn't be wrong in saying it's going to be another positive month. But as always, the markets will be fragmented, so I look forward to seeing what's done well and what hasn't, Andrew.
Yeah, and we need to take things into consideration. It is a seasonal market, the winter market. It does mean, particularly in the bigger prestige markets, that we have a smaller proportion of higher priced properties. So regardless of clearance rates, you can still have some easing in prices. We'll discuss that. But given the strength, particularly the consistent strength of that Sydney market, Michael, I would be surprised if we didn't see some strong results out of Sydney particularly.
Fantastic. Okay, look forward to catching up with you later in the week, Andrew. Thank you.
Michael.